all the stuff that I just showed you. So the fact that this pandemic induced economic shutdown, it was like epic, it was absorbed by the investors. They were totally fine with it. But who was fine with it? Where did that 16% growth actually came in? Well, I could tell you that I started getting phone calls in March when we were down by a third, 34% drop. We think that's the start of the bear market. Like, this is it. This is 2008 all over again. This is 2002 all over again. My 401k looks like a 201k right now. Like, what am I going to do? I need to get out, liquidate everything, sell, 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 sell. And what happens right after that is that bear market, a bear market is when the market tanks, for lack of a better term, and stays down. It wound up being the shortest downturn in US history. And after that, the S&P 500, it rose 68%. So people who feared, panicked, got out at the bottom, liquidated because they think I'm never going to make this money back again, come out. They dug themselves this hole and they stayed in the hole. Versus people who stayed disciplined, they stayed the course, they were rewarded. They did just fine. And unfortunately, this happens every few years. This is like a regular trend, but it especially happened in such a short period of time in 2020. It was phenomenal. But here's the thing that you got to understand, and you'll hear a lot about this. While stocks did climb higher from their March lows, not all stocks recovered. In fact, if you start looking at the year-end highs, if you look at the gains of just 3 stocks, Apple, Amazon, and Microsoft, that actually accounted for almost half of that 16% increase. Think about that. There's 500 stocks. Take those 3. In fact, if you take 24 of the top performing companies out of those 500 stocks, we were actually negative for the year. So if you bet on the wrong individual stocks, you take out those top 24, you're down for the year. So it basically kind of begs that whole question of like, am I picking winners and losers? Now, I know Pinky's got something to say about this because I'm going to talk about interest rates in a second. Interest rates do not help investors much in 2020 because we are at the lowest or near historic lows here. And the idea is that interest rates are going to remain low from the Federal Reserve. I know Pinky's like chomping at the bit right now. Just give me 1 second and I'll let you chime in on this. But we got this $3.5 trillion of emergency money. We got stimulus measures. It was basically the largest action. And then entering, you'll see here, you got 0.09% for the average bank money market. You got 0.16% for the average 12-month CD. You guys know this. You get your checking savings accounts and you see how much interest you're earning on that. So you're less than 1% here. You've got to ask yourself, what's the price of safety? Is this the easiest way to lose my money? Because I've got people in my family and I've got people who I serve who basically say, you know what, Neil, I just want to sit it out. I'm going to let this 100,000, and this is for your real estate clients, obviously, who are thinking about just letting money just sort of sit there. They decide that they're going to buy a property 3 years from now, 4 years from now, and they're going to sit on $200,000 in a checking account because they don't want to risk the market going up and down. That $200,000 is basically earning less than 1%. So the question that you need to ask them is, look, 5 years from now, when you're ready to use that 200,000, is that 200,000 going to buy you the same amount of real estate that it would have bought you 5 years ago? Probably not. The price of everything, milk, eggs, goods, is going up by 2, 2.5%, 3%, yet you're earning 1%. So you're losing purchasing power there. So Pinky, I know this is where I meant by there's a play here because I'm talking about interest rates here. These are not the rates that you're used to talking to this group about. So how does this play in with your mortgage rates?
Yeah, good, great. Thank you for bringing that up because this is a common misconception. But I know not amongst the folks on this group, right? You guys all know that when the Fed drops rates, that is not mortgage rates that they're talking about. That is this Fed fund rate that Neel just spoke about, which is the overnight lending rate from one bank to the other. So if your clients ever come up and say, hey, the Fed dropped rates, the rates are low, that is not the same thing. And you all know that, and you can certainly educate your clients that that is a different rate than the mortgage rate that is applying to your 30-year long-term mortgage or however long you're taking it out for. So definitely something for you to make sure that you're educated about so that you can keep your clients educated on that because you will get phone calls about that if you have not already. And the other thing I'd like to add to this that Neel alluded to, or I think he said, but really is you're talking to your clients and they're talking about if I have money down, don't have money down, and you're having conversations with them about that part of it. It is important, everyone, and Neil can speak to this much better than I can, but as far as how much they should have in reserves and stuff, so certainly important. But there is always the opportunity cost of money that needs to be looked at. So when someone has a ton in savings and they want to put all of it down to lower their monthly payment, that's great. But the conversations we always have with the clients is, what is the opportunity cost of your money? Tying it up into real estate, is that the best place for it, or are you better off, growing it, or knowing that you want the security? And we just had an elderly client that we spoke to recently who wants a security cushion of over 100,000 in their bank account, because for no other reason than peace of mind, right? But that money is earning nothing for her. All it's doing is giving her peace of mind. So, there's like, do you put it into the house or do you go invest it someplace? There's other things that could be happening with that money. And that's where you, as a real estate agent, having conversations like this with them, it would make sense for you not to necessarily give them financial advice, but to suggest that they talk to a professional who can help them with that kind of decision. So not saying that you have to be the expert on it, but for you to know that that's a spot where you can say to them, hey, you should talk to somebody, would be a great thing to do.
Yep.
So.
No. Yeah. So, I mean, with respect to the interest rates itself, I mean, more directly with respect to the property purchase itself, somebody's got a down payment that they're looking to put down, but they're not looking to buy for another 6 months or a year itself. They really need to understand how that purchasing power gets dwindled down there as well, too. I think that's a big part of it. But what Pinky hit on there is goals. If they're looking for an investment property and they're looking to actually put some aspect of this down for the right investment property or the right commercial property that comes in, how is that purchase money going to be held? Is it going to be held in a savings account? Is it going to be held in some sort of low risk brokerage account? Or is it in some place where you can lose a third of it if March of last year happens again? So it's a very relevant conversation of what those goals are and what they're looking for. And, along those same lines, when we're talking about the real estate market and we're talking about these bidding wars that many of you are seeing right now, and then you've got this disconnect between the stock market and the economy, here's the best way that I've heard it described. The economy is what you're seeing when you see things like this looking for a job sign and this store closing, or restaurants who might be struggling, or folks who are out of job, out of work because of the restaurants that are closing. So that all represents the economy. That's the status of things today. And it's not good. It's actually quite bad. And depending on what happens with the new stimulus program, maybe there'll be a lifeline, maybe there'll be a little bit of an infusion there too. The status of the economy is not good. But then why is the stock market doing well? Why is it? Because the stock market doesn't reflect how things are today. That's more of a reflection of what the outlook is, what people are expecting for the future. People are optimistic. So Wall Street's at all-time highs, but many places are still experiencing these shutdowns, these high employments, these overrun hospitals, these economic hardships. But the local businesses like restaurants and gyms and small shops, some of them may never recover, may never reopen. So that's the big discrepancy between what we're seeing today versus what we think we're going to be seeing at some point in the future. And what's the trickle down effect? Now, I don't know how many of you actually do commercial real estate. I'm sure some of you will sell too. Like, you're seeing the trickle down impact of rental payments not being made. You're seeing the trickle down impact of like the commercial properties that are going to start taking a little bit of a hit, although we haven't seen it just yet. That will be something that's long-term speaking, right? So that's really the big discrepancy. That question comes up pretty often. Everywhere you turn, we COVID is huge. We're reminded that the pandemic, I think it's like 350,000 American deaths. They've got millions hungry. The numbers are still going up. That's going to be at the forefront of just about everything we talk about when we talk about what's going to happen in the future versus where things are today. But looking in the future here, there's a lot of optimism in the equity markets. You'll see all this vaccine conversation. You can almost like track when new news about a vaccine comes out. And these investors who are focused on the future and the stock market, that's a forward priced indicator, right? And also what you're seeing here is folks who are sitting on some money, whether it is for a future real estate purchase or whether they're looking for right sizing or downsizing, they're actually starting to gravitate more towards stocks. There are things like Robinhood, where you can invest your own money, or an E-Trade account used to be back in the day, which still exists, where you could do your own investing and all that sort of stuff. So everybody feels like a little bit of an expert when it comes to sort of this investing these days, and a lot of people are gravitating towards that. So we're optimistic, we're bullish on this. Couple that with what happens in the future. What if there's another strain? that can't be filled. And now all of a sudden you got things plummeting. So the best sort of takeaway on this is you got to proceed with caution. Pinky hit on this earlier with how do you plan for this? What I usually encourage people to think of your wealth for yourself or for your clients in three buckets. You've got the first bucket, which is, look, if everything hits the fan, if things go really, really bad, I know that my emergency fund is going to be okay. We spoke about the elderly client right now who wanted $100,000 in their cushion. Was $100,000 6 months living expenses? Is it 12 months living expenses? And you have to earn something on that, but you can't lose that money. You got to have some safety there. So that's that first bucket. Then you have your middle bucket. That middle bucket is, this is what I live off of. Now, for somebody who's retired, it might be pension and Social Security and maybe IRA distributions. That's what you're living off of. You need to take some level of risk there because you need some level of return there. When you're working, when you're earning, maybe you can be a little bit less. When you're not working, if you're retired, maybe you need a little bit more there. And then the last bucket is going to be, look, this is not the stuff that I plan to touch during my lifetime. This is there for future generations. This is there for charities. This is there for other organizations. So you could be very aggressive there because you could be looking at a longer horizon. Make sure that you're proceeding with caution with respect to each of those to figure out exactly how much risk you should be taking and how much reward you really need. Now, turning to our outlook, we got a new president. We've got a new administration. So one of my jobs as a financial professional, as a tax planner, it's reporting and analyzing this political activity. And how is this Biden-Harris administration, how is it going to impact the investment world? So there's a few things that we have to keep our eyes on, which is the future stimulus. And we've got these suggested tax increases, which I'm going to talk about here. And it will impact you, and it'll probably impact your clients as well. Vaccine distribution success or lack of success, we're seeing issues with it right now. It's rolling out slower, but it's also coming through. But is it going to help with new strains? And then finally, these trade agreements. They've been a subject of a lot of dispute during the debates, particularly with key international trading partners like China and India and Brazil. Like, how is that going to actually impact your bottom line? A question that I got a lot is, how does the economy and the market really get impacted when we have a first 2 years of a Democratic president, the House of Representatives, and now this evenly split Senate? So it basically allows Kamala Harris to actually preside over these ties. How does that all impact the stock market? So this is where I got to give my disclaimer. Past performance does not indicate future performance or yada, yada, yada. You guys know that thing. Like, it's the things that people say really fast at the end of commercials. So you guys know that whole disclaimer. So history is nice to look at. It's not a tell-all sign of the future. But if we look at the 10 previous periods where we had this same set of circumstances, and we go back to like 1949, I think I have here, 8 of those were positive for the 2-year period. So if we've been through this circumstance where we have this Democratic president and House of Representatives evenly split Senate for the first 2 years after he takes office, what has happened in the past? Well, 8 of those 10 times we've actually been positive. Now, will that happen in the future? I don't know, because I can tell you during those times we didn't have a coronavirus. We didn't have COVID. So it was definitely a different world. But it's always nice to see where we are right now. If you ask the gurus and the pundits and the talking heads, which I guess I'm kind of a talking head right now too, but if you ask those talking heads, like, what are they expecting? Everybody's pretty bullish. Like, they're expecting the stock market to actually go up. They're expecting the S&P 500 to go up, dividend yields of about 2%. And they're showing that the US stocks could potentially return somewhere between 10 to 11%. That's Barron's and Forbes. Those are the ones that I look at primarily. They're also predicting that the economy, the US economy, is expected to go up by 5%, grow 5%. That would be the fastest rate in about 35 years. You're talking about since 1984. I think that's 35 years. So that would be a very healthy year considering everything that's going on right now. So it's optimistic, but does it matter to you, to your clients? Maybe not. You take the right level of risk based on what bucket you're involved with. These are all good things to know. They're good things to kind of look from an outlook perspective. Everything's going to center back to COVID. There's a lot of optimism about how likely we are to bounce back from COVID and how it's going to actually impact us. Specifically on a tax bracket perspective, and this might be a little hard to read, but by the way, before we finish, or even after we finish, we're going to be putting out a specific workshop on just specific tax planning, because this is something you could spend easily a few hours on just by itself. That presentation will probably be ready by the end of this month, if you will. We were waiting for some of the tax forms to actually come out from the IRS itself, but I'm going to be presenting that. So Pinky, I'm sure, will share that information with you if you want afterwards. But that's when we'll talk specifically and go deeper on this, but very high level right now.
If I could just interrupt, if you guys are interested in that, just put into the chat yes or something so that we know that I can make sure I get that over to you, okay? And add you to it. Sorry, Neil, continue.
Yeah, no, perfect. So in 2020, and really the last couple of years since the Tax Cuts and Jobs Act, which was back in 2017, we had 7 tax brackets, 7 tax rates. And I'll read these. That you got a 10%, 12%, 22, 24, 32, 35, and 37. So what happens is as you go past these numbers for a single person and for a married person, as you go over these numbers up here, you kind of, the next dollar gets taxed at 12%. And then the next dollar gets taxed at 22%. So you got these 7 brackets right now. Today in 2021, there are still 7 tax rates, and these numbers have been slightly adjusted. But just know that every marginal dollar gets taxed at that marginal rate. So you make more money, you pay more money on those particular dollars that you earn money on. This was passed in 2017, this Tax Cuts and Jobs Act, and that was kind of the structure that's been in place right now. What are we expecting to change? Well, these brackets are important because if you look at these current tax brackets right now, this is the single, this is the married, and I'm just going to put the next one up here as well too. What happens, regardless of whether a Biden administration makes any changes, we're going to have a change in 2025. When President Trump got the Tax Cuts and Jobs Act passed in 2017, he didn't have enough votes in Senate to make it a permanent law. So what that means is come 2026, we go back to the way things were in 2016. No, that doesn't mean we can walk around without masks, and it doesn't mean that, you know, we're going to start having like these indoor parties again. Maybe it does, but come 2026, it means we go back to the old tax brackets. So what does that mean specifically for you? Well, take a look at this arrow, and what it means is people who are basically earning income in this range right here, who are paying 24%, all of a sudden they go to paying 33% on those marginal dollars. That's a tax increase of, I can't do math really quickly, but what is that, 8%? 9%. That's a 9% increase in your taxes for making the same amount of money. This is assuming Congress does nothing, right? And one of the other aspects of this, for those of you who might be charitably inclined, is how do we manage this bracket? So for those who are charitably inclined, those who have a lot of healthcare expenses, there used to be this old rule, which is what we're going to do is start accelerating all our deductions. Give money to a charity right now this year. Give money, you know, prepay these healthcare expenses. You know, I got LASIK surgery a few years ago. So the idea was that might be a healthcare related expense. So let me get that paid for in a previous year so I could use pre-tax dollars. So all this sort of stuff, you want to accelerate those deductions. Now, what we're doing because of the way that itemized deductions work is you want to batch them. You want to plan them. We do this twice a year with our clients. We review tax returns at the beginning of the year, and we review tax returns right before the end of the year to identify where can we batch things. So let me just flip back for a second to give you more specific, tangible stuff. If you were going to be giving $10,000 to a charity for the next 10 years, you may never get yourself down to a lower bracket. But if you decided what I'm going to do is take $50,000, for example, and put it into an account, but not give it to the charity, and I'm going to set up this special kind of donor advised fund, which is a free account that you could set up. You get that $50,000 deduction this year, or even a $10,000 deduction this year, but the charity doesn't get it until certain periods outside. So you can batch those deductions. So I know it's a little technical, but just know that you want to batch deductions. You want to time or plan them, not necessarily accelerate your deductions. This one is really relevant to, I think, most of the folks on this group right now, which is these mortgage interest deductions. So these are 2 or more of the widespread deductions that taxpayers would look at, especially for those of us who are in New Jersey. So under the new rules, for mortgages taken out after 1987 or before 2017, you can deduct the mortgage interest for the first $1 million of mortgage debt. They reduced that and they said, okay, only for the first $750,000 for a married couple, or $375,000 if you're single. So for those of you who have mortgages or clients who are taking out higher mortgage amounts, know that there's like a threshold. And if you're over that threshold, you're not going to be able to take deductions. But I guess even more to the point, In New Jersey, we have state income taxes. We've got higher property taxes. We've got all these other state deductions. Doesn't matter what you pay now. If you've paid more than $10,000, you're not getting any benefit on the federal side anymore. You're only able to deduct up to $10,000 here. Now, there's been a lot of legislation trying to change that, but nothing's actually gone through right now. Why is this relevant to you? Well, if you had a client who was buying a home like the one that was in the back of Simi's background over there, right? Something that was a really high-end type home, and you have really high property taxes. And let's just say you've got also this state income tax that you're paying. And let's just say you add all that up together and you're paying $25,000 in all those taxes. From a federal tax perspective, the only maximum amount you could deduct is $10,000. That wasn't the rule until about 3 years ago. So it might impact, definitely it will impact their tax situation, but it might also impact whether or not they're willing to buy that kind of house. Capital losses are important. I'm not going to spend a lot of time on this, but just know that people who are going to be buying and selling properties, if they've got capital losses in the market, you want to know which ones are held over a year, which ones are not held over a year. So again, I don't want to make this a tax seminar because some of you, the coffee's just kicking in right now, and I don't want to put you to sleep just yet. So we'll keep it high level on the taxes too. So just know that capital gains are something that we want to be mindful of. Now, this one's really relevant. Pinky and I grew up in North Bergen, and in high school, we used to hang out at this place called Port Imperial. You go down on River Road, and it was a swamp, and there was a driving range down there. But if you went down there right now, it basically is like Brooklyn West. Like there are these beautiful brownstone-looking homes and these condos and $1 million areas and all that sort of stuff too. I've got a similar situation with a client who's actually in Brooklyn. She bought a home for about $20,000 back in 1965. That home right now is worth about $3 million. Think about that, right? So she's basically got a home that she paid $20,000 for, and it's worth $3 million now. There's two ways that we could do this sort of planning. But let's just say, God forbid, she passed away yesterday. If she passed away and her kids now wanted to sell the home, the new cost basis for that home is $3 million, which means her kids can sell the home for $3.1 million. They would only pay taxes on the $0.1 million. So their new cost basis is $3 million. The gain is whatever the value was at the time of her death. That's the new value for tax purposes. That's huge, right? I mentioned Port Imperial because the same kind of property values went up there in the Weehawken, North Bergen, Jersey City, all those areas. Let's change the facts a little bit. Let's just say she decided to sell the house a year before she passed away. Now, her purchase price, that $20,000, that's the actual cost basis. So she would have to pay taxes on everything between $3 million and $20,000. That step up from $20,000 to $3 million, that is scheduled to go away. I shouldn't say scheduled to go away. That's something that President Biden has suggested would possibly go away. Also, instead of taxing that gain between $20,000 and $3 million at 20% potentially as a long-term capital gain, maybe even 15%, President Biden's administration might possibly increase it so that anything over $1 million would be taxed at 39.6%. So effectively doubling that tax. What does this mean? Well, if you've got properties, if you got clients who are listing properties where they have a lot of gain built up, they've held it for a long period of time, you want to be mindful of that. And if they're sitting on the fence and they're thinking, well, maybe I'll sell it, maybe I won't sell it, knowing that this law might be changed, this might be a reason for you to reach out to them and say, hey, you might be looking at double the amount of taxes, if not more, depending on what that gain buildup is. Hopefully that makes sense.
Can I interject for a quick sec?
Yeah, please do.
So what I heard, that the marketing part of me, right? The sales and marketing part of me heard, I'm a real estate agent. I have investors that I have worked with. And those of you that have been in the business for quite some time, right? I have clients that have maybe bought properties with me 10, 15 years ago. It might be a good opportunity to reach out to them and say, hey, there's a proposal, not in effect yet, right? There's a proposed tax change that could have you pay more taxes. Is it something you're thinking about selling sooner or later? And if in the near future, and if the answer is in the near future, better to do it now than later. Did I understand that right?
Yep, I think you got that right. I
Okay,
can
so
get that
you
right.
guys all take notes on that because that's something that could help be of huge value to your clients and give them an opportunity to really save a whole bunch of money, and you could be a hero to them.
Yeah. And, I'll actually just piggyback on that and say, listen, I teach continuing education for accountants and for financial advisors and for insurance agents. And I tell a lot of them, look, you don't need to have the answers to this stuff. You just need to know that they need to talk to somebody. Like it's enough to say, look, the tax situation is most likely going to change. We got to pay for stimulus money. We got to find some way. So the tax situation is probably going to change. It's probably worth it for you to speak with somebody to see whether it makes sense for you to maneuver some things right now. Right. Um, a lot of people know that we can give $15,000 to people if we want to. There's some misconceptions about that too. It's not you can't deduct off of your income tax or anything like that too. Just know that this is a way to reduce the size of your estate. Why do we want to reduce the size of the estate? Why do we want to reduce the amount of stuff that we own when we die? Why is that even important? Well, it's because of this rule. So right now, the rule is you can die with up to $11.7 million federally. And if you pass away with more than 11.7 million per person, the government will take 40% of the excess when you die. What's included in that? It's life insurance, it's retirement accounts, it's properties that you own. If Congress does nothing and we go through that sunset, what's going to happen in 2026 is you're not allowed to die with 11.7 anymore. You're only allowed to die with 5.5 million. But under a Biden presidency, one of the changes is it might not even be 5.5 million, it might be 3.5 million. So what this effectively means is, I'll tell you, and you guys are realtors, right? So real estate agents, I always get the distinction mixed up. So apologies if I misspoke or I did a faux pas there. So if you had a client who had to sell a property under an estate sale, you'll see that they tend to be lower priced. Why is that? Often it's because the family just either wants to get rid of it or they need liquidity because they have to pay an estate tax. So if somebody passes away with a significant amount of real estate and brokerage accounts and life insurance and all this sort of stuff is in their personal name, and it adds up to more than 3.5 million under a new proposed law, the kids have to come up with 40% of the excess within 9 months of their passing away. Where's that money coming from? That's why estate sales tend to liquidate things. So just know that the possible change there is, hey, we might be looking at anything over 3.5 million being taxed. For those of you who represent, who work with business owners, or those of you who are business owners here, the corporate tax rate, we're looking at an increase. It's 21% right now. It could go up to 28%. If the highest bracket right now is 37%, that could be 39.6. We already talked about the capital gains, basically doubling the capital gains tax. Itemizing deductions, that might be another option there too. Like basically saying no more itemizing your deductions. Everybody just take the same deduction going across. This step up in basis was the one that I was just referring to with respect to how the
Hi, how are you today?
Yep, I'm fine, thank you. So let's talk about some core things here. Now, unfortunately, this also became a big topic during the quarantine and during coronavirus itself. A lot of our clients, or a lot of our clients' family members, had wills. And when they passed away, there's a process for wills. Those of you who have had closings where they're from an estate and you had to provide some documentation, a will is like a recipe. And that recipe has to be given power. So when somebody passes away, if I were to pass away, somebody's got to take my will to the Middlesex County Courthouse and submit it for what's called probate. Probate's when the court will look at this and say, okay, it's a proper will. Now you go to all these various institutions and get deeds filed and all this other stuff. How do you do all that work when we're all in shutdown? So one of the dirty little secrets for lawyers is that's where they make a lot of their money. It's on probate. And it's not because they want to, it's because there's just a lack of education. So again, John's on this call right now, he'll tell you as well. Probate is not horrible in Jersey, but it is one of these things where you want to be mindful of it because it does require work. And the attorneys tend to make a little bit more money on the probate side than they do on when they're doing proper wills or proper trust planning. It's also public information. So if we wanted privacy, what I do suggest is you don't want to go through the whole probate process. Instead of a will, imagine creating a trust putting the house and the checking account, the savings account into this sort of vehicle right now so that when you pass, this automatically goes privately to the spouse, to the next of kin, to the family, whoever you want it to go to. During this during this whole quarantine, going through the probate process, it's hard enough when you've got to attend a funeral and only 10 people can be there. Imagine having to deal with the logistics as well too. So there's been a lot more talks about trust. And along those same lines, we talked about the accumulation and the distribution phase. There's been a lot of talk about people not wanting to deal with nursing homes. So you're probably going to continue to see an uptick on people looking for 55 plus community homes, places where they can age at home and age in place and make sure they can afford to age in place. So for those of you who do work with 55 plus communities, active adult communities, I think you're going to start seeing a lot more interest because you've got low interest rates. You want to make sure they have enough income. They want to make sure they can meet their healthcare costs. So as they're looking at this, you want to be mindful, at least bring up the conversation with clients about what's it going to cost you to age at home. Is this the right home for you to live in? Do you have a bathroom on the first floor? Are there steps going up there? Can you have an adult child move in with you? Because just the nursing home costs alone, in 2019, if it was $102,000, medical inflation rate is 3.5%. You're looking at $144,000 a year in 10 years and $203,000 a year in 20 years. Where's that money coming from? And do you want to be in a nursing home when a pandemic kicks out? Generally not. So, and we've got higher demand. People are living longer. It impacts the family dynamics. And we don't know if Medicaid's going to still pay for all that sort of stuff too. So finally, and I want to have plenty of room for questions if anything comes up here too. Just know for 2021, there is plenty of uncertainty. You got to stay disciplined. You want to stay on top of your stuff. Don't get confused with the economy and the market. All this stuff is on the slide right now, but just a pop quiz for everybody out there. CNBC, Wall Street Journal, New York Times, Forbes magazine, Kramer, who do they owe responsibility to? It's not you. The financial media industry does not owe a responsibility to you. They're not there to educate you. They are there because they owe a responsibility to their shareholders. How do they fulfill their responsibility to their shareholders? They get you to click. They get you to watch. They get you to share. This is the same reason why you can be watching the Wheel of Fortune at 6 o'clock. They'll tell you about a deadly virus that's waiting outside your front door, but they won't tell you about it until the 11 o'clock news because they need you to click. They need you to watch. They need you to be engaged. They are not there to educate you. Tune out the noise. I have one guy who actually calls it financial pornography because it's intended there to just draw you in and lure you in. So tune out the noise and focus on what's relevant to you. Proceed with caution and focus on your own personal goals. Now, just a couple of ways that we can sort of wrap up here and then continue with the questions. We are going to have this regular communication. You know, these tax forms just came out here. And I talked about by the end of this month, we're expecting two things. We'll have a mailing that we put out. It's a regular mail. It's a tax report, and it's actually a to-do list for a lot of folks. It's actually one of our more popular mailings out there. It's basically how to address your conversation with your tax preparer. Anybody who's interested in that, obviously reach out to us. We'll give you our information via Pinky. And what we'll also send out, and we'll have Pinky distributed too, is this link that people can use if they did want to set up a time just to chat with me. It could be legal, it could be tax, it could be financial, it could be how I can convince Pinky to help me to get a puppy. Like it could be anything you want to talk about or I might want to talk about. So certainly take me up on that if you wish to, but we'll send that out as well too for anybody who's interested. And there'll be a little survey in there too that you can also fill out if you're interested. So Pinky asked me to finish it up with enough time for questions and answers. I hope I didn't ramble on too much, and I hope this was helpful. But the floor is yours.
Thank you, Neel. Can't believe how much you packed into that. That was really impressive. So you guys, I'll let you have some, I have some thoughts that I thought might be relevant for you, but I'd love to hear everyone's questions, feedback, something that you took away that might be worth sharing with others as far as how you want to apply this either personally as a real estate professional or in your finances as it relates to being that, or to your clients and how you can serve them better. You don't all have to jump at once.
I'm mesmerized, everybody.
I'm not afraid to call on people. You guys know this, right?
I have a question.
Thank you, Simi.
Neel, thank you for the beautiful presentation. It kind of opened my eyes to so many things that we've not planned or thought about personally, besides educating clients. You mentioned about preparing a will and that going into probate, and if the will is done correctly, then it's released from probate. But I also heard that you can do a living trust, a revocable trust, and it doesn't go into probate. Is that correct? And
Yeah, that is.
what's the advantage of doing that?
That's a great question. And when it comes to how things get passed down from one person to another in the event of somebody passing away, there's only three ways. And the first is by title. You don't have to go through probate when there's title. So Pinky and I own a home together. If I were to pass, Pinky doesn't have to go through probate to get that home because we own it as joint owners. Now that could be the same thing with me and my mother. My mother and I own a brokerage account together, for example. If God forbid something happened to my mom, I would become the sole owner of that brokerage account. Now, do I have to share that with my sister? Probably not. So title is a quick and dirty way of doing it, but sometimes it has drawbacks associated with it. That's not a probate asset. The second way that you avoid probate is by having things like a beneficiary designation. So if I said in my will, everything goes to Pinky, but in my life insurance policy, my $1 million life insurance policy is going to get paid out to my girlfriend, that life insurance policy will go to my girlfriend. Pinky hates that joke. But for example, that's another way to avoid probate. The third way is everything else, and that's by probate. But what you mentioned is one way to kind of solve all those issues. This vehicle that I was talking about right now, it's open. Imagine that instead of Neel and Pinky owning the home, we had it in here. Imagine that instead of having the brokerage account owned by me, we had it in here. This is a trust. And because it's open, there's no lid on here, I can change it, I can modify it, it's revocable. So that's a revocable trust. If I decide that my kids just ticked me off one day and I want everything to go to a charity, or if they're doing fine financially and I wanted to bypass them and go straight to my grandchildren, the revocable trust allows me to do all that. I can change it and modify it as my circumstances change. So those are all ways to avoid probate.
Thank you.
You got it. Thanks for the question.
Thank you.
Hey, Neel, thank you very much. That was really insightful, especially knowing that, since I'm a CPA, this actually resonates with me even more. But when it comes to like estate and, trust, like how does like specific state laws impact especially estates? Because I met this, the reason why I asked is because like years ago, I met with this financial planner who mentioned something about like, although I reside in New Jersey and resident in New Jersey, he said that, your estate could be anywhere in the US and like certain states are just more beneficial to have. How does that conversation lead into like, what you do from your day-to-day life?
Yeah, that's very relevant because especially right now when it's 20 degrees outside, right? This is the season for snowbirds, and especially for us who live in Monroe, where there's a lot of 55 plus community, people will actually take off to Florida. So it's very common for a New Jersey resident to have a residence in Florida as well too, and maybe they inherited a property from one of their family members who lived in Pennsylvania. So the rule about probate and the rule about estate administration, this is really relevant for any of you because it could really slow things down for some of you guys on your real estate deals, is if I own a home in Florida, I'm a New Jersey resident, I own a home here, and I inherited a property from Pennsylvania, the state in which I'm a resident is where you're going to go through your main probate. That's where the will is going to be submitted. But if I own real estate in multiple states, somebody's going to have to deal with what's called an ancillary probate. It's like another probate process in every state in which I own real estate. That means hiring lawyers. Like there are some states, like New Jersey is not a bad probate state. California, it's a living hell. New York, it's rough. Florida's not so great either. So the answer to that, the solution to that usually is creating the same guy, having some version of a trust that will own the Florida property, that will own the Pennsylvania property, and possibly even own the New Jersey property, so that when I pass away, this didn't die with me. This trust is still there. It'll just be there for the benefit of somebody else. And nobody has to deal with all of that as other process, like hiring another attorney in Pennsylvania, another one in Florida, and then one in New Jersey to actually deal with all that probate administration part of it too. Did that help? It
did. And how does, like, if something changes within the state laws or what have you, like, do we have to be aware of things like as we are going through our process, like, how does that fit into, like, how often are we supposed to update it if, say, certain state law changes? Like, how
Yeah,
does it?
good question. New Jersey got a lot cheaper to die in. If you remember, a few years ago, we passed the big gas tax where all our gas prices went up. And you have to say it really slow, because if you say it too quick, it sounds like big ass tax, which doesn't good. So you have to say big gas tax. Gas went up by a quarter a gallon, but the trade-off was now there's no more estate tax in New Jersey. So New Jersey doesn't have a tax after you die that's going to be imposed on your estate. So that's the trade-off there. Now, for those folks who had really complex documents in New Jersey, does that mean that everybody's going to go back and change their wills? The answer is no. Usually you plan with enough flexibility if it's done properly so that it'll still work. Like, you want formulas in there too. It may not be optimal, but it will still work. It's still a valid legal document. I usually suggest if you don't have somebody who's staying on top of, so again, if somebody's working with us, we're meeting with them 4 times a year on the investment management side, but we're talking about legal planning, financial planning, tax planning, and retirement planning, and all that stuff at the same time. If you don't have somebody who's staying on top of it for you, when you change the batteries in your smoke detector, which should be once a year, daylight savings times, it should be a good time to reflect on, is this a good time for me to at least revisit how my plan works? Does it still fit me?
Yeah. Makes sense. Thank you.
Sure.
Another question, Neel. Does your office do financial planning, like, mutual funds and stuff like that? Or what type of financial planning do you guys do? Do you do it in a broad spectrum, or people can specify what they want?
Yeah. So people do work with us on a sort of a la carte package sometimes too. They just want to come in on the legal side. They just want to come in on the investment management, some on the financial planning side. For compliance purposes, they're 2 separate companies. We have Beacon Wealth Solutions, which is an investment advisory firm. That's where Neel, the certified financial planner, Neel, the Series 65 licensed guy, works. And then in our law firm is when we do wills and trusts and estate planning. The tax strategies come from both sides itself too. And yes, when we're doing, what I don't do, I'm not a stock jock. I'm not going to try to find the next Amazon. I'm a big believer in financial plan is going to drive what it is we're going to actually be using to invest. So, for Pinky and I, who are in our mid 40s, we're going to invest in a certain way because we have certain goals. For my daughter and my son who will graduate college in a few years, they're going to invest differently. For our parents who are in retirement phase, they're going to invest a little differently. So it's coming up with the right financial plan and then using the right tools to make sure we implement that plan. Mm-hmm.
I have a question that I think maybe you guys might have also. So you get a client that presents themselves to you. They say, I've got $200,000 available. Should I invest it in real estate or should I put it in the stock market?
The answer is
obviously yes. Those of us that are in real estate and mortgage have a bias towards real estate. What's your answer to that question?
So the answer is yes, or maybe. So the question is almost like a little bit of a false question. So if I just walked into a Home Depot and I said, should I buy a lawn cedar or should I buy sod? For those of us who have houses, you can't really answer that question because you don't know what it is I'm accomplishing. I mean, yeah, you get that I want grass. So I think the question is, what else do you have in your life? Real estate is a fantastic tool and it's a great way to diversify, but as good as it is from a cash flow perspective, it could be from a cash flow perspective, it's also highly illiquid. What are your liquidity needs going to be for the next few years? Like, are you gonna need cash in your account? Are you planning to pay for a kid's college or your own retirement at some point? If so, are you gonna be able to tap this cash? Hypothetically, if we were in 2007 and somebody had a massive real estate portfolio and they were in their late 70s and they had no source of pension, and then the market just plummeted, are we now going to be forced to sell all this real estate when everything's down by 40% just because we need the liquid cash? So the answer to the question is going to be a lot of questions for me about, well, what are your goals? What's your other source of income? What are your other assets? How are we going to make sure that this is one component of it too? What I don't do going back to Home Depot, what I don't go do is go into Home Depot, buy all the tools and come home and figure out what I want to build. What I will do is figure out what I want to build and then go to Home Depot and then buy the right tools and use the right strategies to actually implement those tools. Coming in and asking whether I should invest in real estate, whether I should invest in the stock market, whether I should have the money sit in the account, that's like asking me which tools to buy without knowing what it is we're building.
Good analogy. And so as a real estate agent or mortgage professional, right, what you just said was really great. We obviously aren't going to go into that level of depth. Are there 2 or 3 questions that you can think of that we should be asking our clients? And I'm putting you on the spot here, so it's okay if you want to get back to us on this, but that you can think of that you say, hey, these are really good questions that you can get your clients thinking about, and then direct them to the right folks. But if you, so that way they understand that we're not just in it for the commission, if you will, right? We truly want to, and I know everyone that's on this call personally, I know they are all here to serve and want to do the best for their clients. So what questions do we ask, or what do we say that helps them know or helps them really make best decisions overall?
Yeah. So 2 questions and a tip, which I'll share. And this is not a challenge, but I'll be shocked if 3% of the people do it. So the first question is, what's important to you? It sounds really simple. The second question is why? And then shut the heck up. So ask the question, shut up. And when you think it's ready, time for you to talk again, shut up some more. Like, I've literally been told, try to keep like a 7-second count. I have such a hard time with this because I'm a talker, as you could probably tell. So it is very, very difficult for me to shut up. But what's important to you? Because ultimately, if you're trying to form a relationship with these clients, if you're forming a relationship with these people and you truly want to help them, and they come to you saying, I want to buy a bigger house, is that important to them? No, they don't care about the bigger house. What they want is, I want my elderly parents to be able to move into me. I want my kids to have a backyard. I want a place where I can age in place. I want a place with a good school district for my kids. They don't care about the house. It's what the house symbolizes. You're not going to get to that by talking. You need to ask them what's important to them, and then just shut up. And then the next step is really ask them why it's important to them. You've got to let them talk. The more we talk, the more we're failing. God gave us 2 ears and 1 mouth for a reason, right? So we've got to just ask what's important to them and why. You can't go in with tools and then expect to wow them. Don't go in with an MLS listing of 30 properties or anything like that and say, look, those are tools. What's important to them? If they're investors, are we looking for cash flow? Because that's what we need. Are we looking for tax savings because we want depreciation on the real estate? Or are we looking for something that's going to go up significantly in value and we can sit on it for 10 years? Very different goals, very different way of accomplishing what you want to accomplish.
Awesome. Thank you. That was deep at so many levels. And I think that applicability of the shut up rule is super awesome in every aspect of it, not just when we're talking about the real estate investors, but as you're talking to your sellers and to your buyers, right, in general, and just trying to understand how you can serve them best is really, really awesome advice.
Thank you.
Oh.
And thank you all for getting my wife to say I'm awesome. You guys, this is recorded for the record, so.
Any other questions from anyone here? And you said, I had made a note from something that you said earlier, where you said the why part was an earlier part of the presentation, where you talked about the why and why you're thinking about what the goals are. So that you just kind of brought it back, because that was my note, was to make sure that when we're asking our clients and having the conversations with them, that we do ask them why, because it helps us figure out what they truly want. And when we can connect with them at that deeper emotional level, it gives us to serve them at a level that we wouldn't have thought if we just said, do you want 2 bedrooms or 3, right? Or, what do you want to do when you sell the house? So it's really better questions asked. The other note that I made about something that you mentioned was about how a lot of folks are not looking to go into nursing homes as much anymore, given the current environment. So when I think about what that means as far as real estate, right, for you guys, it means that there's either going to be folks that are going to be maybe making moves into larger homes if they're going to be accommodating more members of their family potentially, or folks that are not going to be selling that you would have expected to sell when it comes time, when they're older in life, right? You might have thought that there'd be a certain turnover that may not be happening, which may be, quite frankly, adding to the inventory problem that already exists, right? Of folks not wanting to leave a home. So you might see some fewer homes going on the market as a result of that too. So it'll be more of a challenge for you to find ways to create inventory, I would say, and finding places for the new folks, the younger folks to come into.
Mm-hmm. Yeah, for sure.
Yeah, awesome. Well, thank you, everybody. Unless you guys have anything more on your plates and as questions that you have, Neel has offered, he does have a newsletter that he does with tons of useful content. So if you guys want to be on that list, you can let us know. I'm sure he can put you on it. You guys can follow him on Facebook, Instagram, Twitter, LinkedIn. He's everywhere. And he does useful videos and content also. So if you're not already following him, feel free to do so, because I know I'm biased, but I happen to think he's very good at taking the difficult and making it really simple. And hopefully after this hour, you guys agree. But yeah, so feel free to follow him in those aspects. Thank you for joining us. And remember, March 10th is our next session, and we'd love to have you join us for that one too. Thank you for taking the time here this morning.
Excellent. Thank you for having me.
Thank you.
Thanks for having us.
Okay, thank you. Enjoyed it.
Stay safe, stay warm.
Thank you.
Okay, bye-bye.
Bye-bye. Thank you. And thank you for the
very
question.
much.
Yes, thank you.
Bye.